With high inflation and interest rates on the rise, investors are scrambling to find the best ways to keep their money growing. Some are looking at factor-based investing as a winning strategy in today's challenging economic environment. Stick around. Craig Lazzara, Managing Director at S&P Dow Jones Indices, joins us right after this. Hello, I'm Stephanie Stanton with ETF Guide. We are so glad to have you. If it is your first time watching, hit the subscribe button and post your comments below. Factor investing is an approach that involves targeting specific drivers of return across asset classes. Studies show that some factor-based index strategies have historically outperformed their cap-weighted benchmarks. By allowing investors to capture key market trends, factor investing also lets them customize their portfolio's equity exposure. Joining us to discuss factor strategies is Craig Lazzara, Managing Director at S&P Dow Jones Indices. Welcome to the show, Craig.
Thank you, Stephanie. I'm delighted to be here.
Yeah, it is so great to have you. So ETFs linked to factor-based index strategies have seen significant investor demand and asset growth. Tell us more about your definition of a factor index and how investors and financial professionals have traditionally implemented factor-based index strategies.
Let me take the second part of your question first, Stephanie. The definition of a factor is I like to give almost an academic definition, and that is to say, think of a factor as an attribute with which excess returns are associated. So there's lots of academic research going back over many years. For example, Fama and French famously, there's a lot of alliteration in that sentence. Fama and French famously said in 1991 that small size and cheap valuation were factors of return, meaning that they were qualities with which excess returns were associated. And there are a set of factors, for example, low volatility, momentum, quality, are all things that we typically think of as factor strategies. Now, traditionally, meaning say 40 or 50 years ago, investors could implement factor strategies simply by hiring active managers. So you could hire a value manager or a small cap manager, a defensive manager. All of these things were ways of accessing factor strategies, but you also access not only the factor that you wanted, but also the individual manager's stock selection ability or lack thereof. What's happened quite dramatically over the course of the past 20 or so years has been the growth of ETFs in particular, and to some degree mutual funds, but ETFs that are linked to factor indices. And I like to say that ETFs let you indicize. In other words, to deliver in passive form this pattern of returns that you formerly had to pay active fees to get. So the history of factor indexing in the last 20 or so years has been largely a history of indicization and efficiency for users.
So what makes Dow Jones Indices approach different?
A couple of things, Stephanie. The S&P Dow Jones Indices is, as our listeners will know, the proprietor of the S&P 500 and its many offshoots. So one of the things that distinguishes what we do from our competitors is that almost all of our large cap U.S. factor indices are based on the S&P 500. So to the degree that customers are accustomed to using the 500 as a benchmark, they'll feel very comfortable with factor indices that are derivatives of that. The second thing that we do, and in contrast, I think, to some others, in the tug of war between complexity and simplicity, we tend to err on the side of simplicity. So to give you an example, one of my favorite factor indices is our S&P 500 low volatility index. It is the 100 least volatile stocks in the S&P 500, rebalanced every quarter. It is designed to access the low volatility or low beta factor, and it's done very well over time at doing that. There are other ways to access low volatility. You can have an optimization, you can have a much bigger portfolio. But as I say, we tend to err on the side of simplicity wherever possible, and I think that yields some advantages.
Yeah, and when looking back at history, many studies have shown that factor-based index strategies have historically outperformed their cap-weighted benchmarks. But now here we are, it's 2022, the equity market has declined. How has that affected factor index performance?
In terms of absolute returns, if the equity market's down, most equity-based things, including factor indices, will also be down. So most of them have had negative total returns. What we've seen in 2022 is really the resurgence of two things. One is value as distinct from growth. I mean, value meaning just cheap stocks, the cheap stocks in terms of earnings, book value, and so forth. If you look at the spread between the S&P 500 Value Index and the S&P 500 Growth Index, for the last 12 months, it's in like the 98th percentile of historical experience. So value has done very, very well. I would attribute that to the increasing interest rate environment that we've experienced in 2022, because growth stocks typically achieve their earnings farther out on the time horizon. As the discount rate rises, the valuation of growth suffers disproportionately. But it's notable that this resurgence of value that's been so strong has come after almost a decade when growth dominated quite dramatically. So it's been quite a reversal, and may well have farther to go. The other trend that I'd call attention to in 2022 is the good performance of what I would call generally defensive indices. I mentioned low volatility earlier. Low volatility is a great example of that. It tends to do better than the market when the market is down, and worse than the market when the market is up. So here we're in a period of 2022 when the equity market is down fairly significantly, and defensive strategies, low volatility, high dividend aristocrats, others of those that we offer, have all done quite a bit better, which is exactly what you would have hoped to see and exactly what we designed them to do.
Yeah, it makes a lot of sense. Now, although it may seem like a minor point, you favor using the term factor index over the smart beta label. Tell us a little more about that.
It's not a minor point. It's not a minor point. It's a big deal. Well, it's here's the reason. It's to call something smart beta, and it is. I mean, I use the term myself on occasion when I slip. To call a factor index smart beta implies that there must be some other sort of index that is dumb beta, or at least less smart beta. And typically what's meant by that, or by the people who like to say smart beta, is that the things like the S&P 500, which by definition supply the beta, the market sensitivity, give you the market sensitivity of the market, are somehow less than fully intelligent. And the argument I would make is that one of the smartest things an investor can possibly do is make a substantial investment in the S&P 500 or other similar cap-weighted indices, because the data are very clear over long periods of time that a simple cap-weighted index fund like one based on the S&P 500 would have outperformed something on the order of 90% of all active managers. So far from being a dumb thing to do, it's one of the smartest things you can possibly do. And factor indices can supplement that behavior in particular ways, but it's to say that the S&P 500 is somehow less than smart is incorrect.
Yes, we definitely want to stay smart, right? Let's keep it smart. All right, all of that to say, let's talk about the future. What future developments or innovations do you see ahead for factor indices?
Well, one I don't see is the discovery of many new factors. I mean, we talked earlier, a moment ago, I said that value and small size are very well established, low volatility, quality, momentum. I don't think there are 5 or 6 others waiting to be discovered. I mean, we've got a pretty good description of the factors that influence the U.S. and for that matter other equity markets. I think we'll see continued indicization as investors come to realize that they can access these factors in an efficient and low-cost way in the ETF market. The other thing that I think we see a lot of interest in is the possibility of combining factors. So, for example, I mentioned earlier low volatility as an example of a defensive factor, or sometimes we call it a risk mitigator. There are other factors that are, I would call them risk enhancers, so something like growth or equal weight strategies typically have higher volatility than the S&P 500 or the indices on which they're based. And what we've seen is that when you combine a risk enhancer with a risk mitigator, you sometimes get a better trade-off between risk and return than you can have by having either one of those individually with say the S&P 500. So the notion of combinations, I think, is something that is increasingly investors ask about, and we're likely to see increasing growth in.
All right. Well, we are going to have to leave it there. Craig, thank you so much for stopping by, sharing your insights.
Thank you. Delighted to be here, Stephanie.
Yeah, we really appreciate it. Take care. Good luck, and have a great holiday season.
Thank you. Same to you.
And to learn more about the S&P 500 single factor indices, be sure to visit www.sbgglobal.com/SBDJI. The link is posted in the description section below. And don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one, ETF Battles, and many others. Thanks so much for watching. We'll see you next time.